panel 4, last panel of the day. What next? Global opportunities for covered bonds, covered bond investors. That's what we're here to talk about. My name is Bill Thornhill. I'm editor of Global Capital, and maybe you could just...
Yeah, I'm Andrea Moraro. I'm part of the financial institutions in EBRD. I'm responsible for investment in covered bonds in European emerging markets.
And I'm Anne Caris, and I worked at Banque Pictet in Geneva on the treasury side.
So we'll start off with a question for the audience. If you've got your apps out, just to wake you all up and liven you up. Are we engaged, everyone? Question is, to what extent could growth in the new markets help revitalise dollar volumes? To what extent could growth in new markets help revitalise dollar volumes? So when we're talking about optimal allocations, and what are the main things that you look for when you're considering covered bond investments?
I mean, when we buy covered bond, I mean, first of all, we look at regulation, and they have to be repo eligible. If they are not, it's a no-go, so I don't have to do any analysis. The other key criteria today, because it's in the regulation, it's the minimum rating, so it has to be AA minus. And then we have obviously our own rating criteria. So today we only buy AAA covered bonds. And then obviously once I ticked those two boxes, then I can go into the analysis. So we have to be comfortable with the sovereign, with the issuer, and that's actually a very key component of the analysis. And here actually we have our own internal minimum rating because we don't want to have a major gap between the strength of the issuer and AAA covered bond. I mean, we have seen techniques like conditional pass-through, where you can have a low or a weaker issuer and still have a AAA covered bond. And then obviously we have to be comfortable with the legislation, the housing market, if it's a mortgage covered bond. And finally, obviously, we look at market liquidity. Being a treasury, we want to be able to sell when needed, and we have as well some limits in terms of duration, and the pricing has to be attractive, which it has not been recently, so we have been on the side.
You should have bought some emerging market bonds, but they don't get your rating, unfortunately.
AAA.
Yeah, so maybe that's a bit of a contrast to your investment mandate.
Sure. Yeah, maybe just a bit to put it in the context. I mean, I'm sure that many of you are familiar with EBRD, but those that are not, basically we are a development bank focusing on European emerging markets, but also Turkey, CIS, now a bit of North Africa, 4 countries. So when we're looking at investment in covered bonds, we have a dual mandate. So on one hand, we invest like any other investors on commercial principles. We invest in public insurance, but we also have a developmental mandate, and this has to do with the development of the local capital markets, which is one of the 3 strategic pillars for the bank. So when we look at an investment in a covered bond, we look at a few things. So first of all is the legislation. It's very important. We have to be comfortable with the law. So far in our markets, we benchmarked to the EBA recommendations that have been very useful. So we looked at the different criteria, and we try to map it with the local legislation. If the law is not there, or if the law did not comply with EBA, we, as part of our developmental mandate, we try to amend it. And we've been quite successful in some jurisdictions so far. We've been working in Poland, and we've seen already issuances. We've been working in Romania. We're hoping for some issuance. We are currently working in Croatia. We worked in Slovakia as well. So we are basically, so if there is no law, we are trying to develop. If the law is not appropriate, we are trying to amend it and bring it according to the international standards. Issue size. We have a bit of a different because of our, as I said, we look at the development of the market, we have to consider even the small issuances. And in emerging markets, in European emerging markets, in most of the cases, these issuances are very small. They are in local currency. So invested in 100 euro million equivalent in Poland in local currency. We invested in even a smaller size in Hungary. So size doesn't really matter as long as it's not very, very low, like 10 million. But we consider also small issuances. Rating, we don't have a minimum rating, but we require a rating. And this has been proved challenging in some markets because the local investors, they don't require a rating. So we have few countries like Hungary where they've been just a couple of rated issues. We pushed for rating, so now we have one more and we're hoping to have another one rated. So we require a rating. We can't invest if it's not rated. Then on the ECB eligibility, we don't require it. However, it's good if it's there. However, it's not a minimum requirement. Transparency is very important for us in some of the markets, especially at the beginning when the first issues coming to the market, it was hardly any transparency. So there was no disclosure of the information. So we work a lot with the banks because these banks are our partners, the traditional partners. Some of them we are having also equity investments. So we're trying to work with them to improve the disclosure for the investors.
That's pretty exhaustive. Thank you very much. So the question didn't actually seem to come up. I don't know if there's a problem with it or, oh, there it is. Okay, marginally. Okay, all right. So, Anne, do you buy across all currencies or just mainly is it euros?
No, so we buy in euro. We buy as well in US dollar, obviously Swiss francs, but we don't get a lot. Yeah. And then we have some sterling as well to a lesser extent. And then we have a bit of Canadian and dollar.
So you buy everything basically?
Not everything. I mean, the thing is, looking at the markets which are going to come up, aside from the rating constraint, or the fact that regulation says that it has to be EU or EEA. If Brazil comes up in real, it would be a no-go for us. I mean, we won't be able to buy.
Because the rating is too low.
I mean, the rating, and then if, local currency, we cannot do, we don't do everything. So.
Okay. But for you, emerging market currencies should be no problem, or?
Well, what we've seen, the covered bond markets in our region are relatively small. So with the exception of with Poland that has euro benchmark issuance and we invested. In Hungary, it's been local. Slovakia, well, it's euro market, sub-benchmark. Turkey, we invested in both the euro benchmark and Turkish lira as well. Yeah. We are supportive of the local capital market. So for us, what we like to see ideally is to have issuance that tap the local market as well and international.
What we see, I mean, in the emerging markets generally is quite a lot of emerging market investors are buying in dollar-denominated sort of currencies, but covered bonds seems to be the depth of liquidity is in euros, which creates a sort of a bit of a conflict. Do you think that issuers in some of these emerging markets, there might actually be a sort of a hybrid type of investor that comes out, which would cross over an emerging market investor who understands covered bonds? I mean, what's the scope? Who would necessarily potentially buy dollar covered bonds? Do you see any scope for growth in dollar covered bonds?
Well, out of our markets, I'm thinking the only one that could do dollar covered bonds is Turkey. Turkey, traditionally, Turkish banks, they issued unsecured, all dollars. They have DPR programs, all dollars. So they have a traditional dollar investor base. I think probably 80% of the funding of the external funding of the Turkish banks is in dollars. However, when they worked on the cover bond programs, and they considered they were tapping on the European cover bond investors. So Vahiv went on a euro benchmark issuance. I think everything has to do at the end with the swap cost, because for the Turkish banks, I mean, all the mortgages are in Turkish lira. They don't do any FX, and they have to swap this. So if it's more favorable to swap it into dollars, then they will go for dollar investors, which are their traditional investors. If it's euro, they will go to the European investors. So I think there is potential coming out of Turkey if they will decide to tap the public market again, because what we've seen in the last couple of years has been mostly private issues in local currencies.
Do you have any, I mean, I don't know, but the cost of a euro swap for a Turkish issuer is in the region of like 11% or something?
Yeah, actually, I just checked before this panel. It was, it's very fluctuating, but it's between 11 and 14%.
And how is it for dollars, do you know?
It depends. It's kind of changing.
Okay.
I haven't checked the dollar one,
Okay,
actually.
okay.
I checked just the euro because...
When we're thinking about potential for growth, I mean, Canada has been an obvious global market, which has been a great one for you to invest in.
Yeah.
But what regions do you believe have sort of potential for you to, and when you look at sort of the global markets that you can invest in, AAA covered bonds, AA countries?
I mean, I think in Canada there is still some potential in the way that if they lift the 4% limit issuance, then some issuers like National Bank of Canada or Desjardins would be more active, and those bonds could be more liquid, and this could be potentially a candidate for us, and they are not right now. So I think it could open up to some
smaller issuers.
Yeah, smaller issuers for us. I wish that today we had more positive news on the US, but it seems that it's not a market for now. I mean, the Baltics, when they will be coming, I mean, the sovereign is a single A, banks are single A, so let's see, you know, what will be the covered bond rating, knowing that, I mean, the Baltics has a lot of Nordic influence, so I think that's a story I will be following. Okay. But it's true that otherwise, I mean, looking at the global market coming up, it's tough. It's tough.
So Australia, obviously, New Zealand.
Yes, but then it all comes back to regulatory treatment.
Right.
And the fact that Australia is not repo eligible, not being G10, then we can't.
It doesn't tick the box.
No, it doesn't. So.
Okay. So Canada potential issuance there, and for the small guys as well. And you know, I've been talking to some people, and you know, maybe there's scope one day for them to do multi-issuer deals where people aggregate mortgages and issue one covered bond. So that could potentially be interesting to you.
Yeah, I mean, definitely. We saw there was a market in Spain, I mean, the multi-cedulas, and it worked well. I think it could be a potential. I mean, the only thing I will be looking at is that you need to have a similar creditworthiness among the issuer. Because we could see that during the crisis, you had discrepancies, and then investors got worried about some name, and then they wouldn't buy the whole issue, even though you had no cross default, etc. But definitely that's something we could look at. And I mean, Canada is a great market. I mean, right now you do have some weaknesses, but what we like especially, it's one, the financial strength of the issuer, and two, the fact that you have super strong supervisors. I mean, we can feel that there's a pilot on the plane, whether with OSFI, with the provinces reacting to what's going on in the housing market, with a CMHC as a specific supervisor. So
you've got strong issuers in other parts of the world as well. Taking for Korea, for example, or Singapore, but again, it's just this repo eligibility.
Exactly.
So for you, I mean, that could be potentially could change if there was equivalence.
I mean, definitely.
Equivalence came to fruition.
Yeah, I mean, Singapore, it's only because of the eligibility. I mean, otherwise, it's a AAA sovereign. Banks are AA, they're strong. Housing market is okay. Legislation is strong. So it really comes to regulatory treatment.
So turning to potential growth in the emerging markets, where do you see the next? I mean, we've had yesterday, I think, the first deal from M-Bank, which went very well, 900 billion booked for 300 billion, did I say? Million, I meant. So yeah, that was hugely. So Poland obviously is doing well. But where else can we expect to see growth coming through? I mean, the Turkish banks have been very disappointing so far with only one deal, but there's issues going on there with the swaps, isn't there? So.
Yeah. Well, Turkey, as you rightly said, it's a big market. There are about 45 billion of mortgage loans outstanding in the market. So there is a huge potential. So far, the Turkish banks issued
Was that 45 billion euros?
Yeah.
Yeah. Okay.
So far, the Turkish banks issued. We called it SME guaranteed bonds. We're not covered bonds, but they are issued under the same legislation of covered bonds, but we call them the SME guaranteed bonds. These were private placements issued 3-4 years ago, targeting mostly the IFIs. They were trying to get some private investors, but at the end they ended up being private deals with the IFIs. So they have programs in place. There are 5 programs that have been approved by the Capital Market Board in Turkey. They are all rated programs. They are well structured. The legislation, it's quite good. We benchmarked against the EBA at one point. I think it matches, I don't remember exactly, for 13 out of the 17, but quite a number of boxes. They have a high level of OC in the programs. It's a minimum 20% committed OC in most of them. So the programs is there. The fact that the banks didn't issue, it's a bit disappointing. One reason is the cost of the swaps, that it's basically having a big impact on the economics. The other is also the differential with the senior. Turkish banks have access to senior funding. It's true on the short term. They prefer to issue on a short term, on a rollover basis. They roll over these loans every year rather than issue on a cover on a longer period of time. So, but I think the main issue is basically the cost, because we've seen quite a lot of demand coming on the Turkish lira covered bonds. So what we've done together with other IFIs, we invested in the covered bond programs through a type of private placement Turkish lira format. Because we have access to the local currency, it's easy for us to hedge in the market. So we could provide the Turkish lira so they avoid the hedge. Because all the residential mortgage in Turkey, it's Turkish lira, and it's good because banks, they don't want to, have an FX induced to the consumer. So this is healthy for the market. But on the other side, it's very difficult to basically hedge it if you target international investors. And we try to do even local market, having some small issues on the local market, but the local investment base is not really prepared for such a longer tenor. So we invested in, for example, one of the NPL services that we are a minority shareholder. We invested in like 1 to 3 years senior. But if you want to go on a 5-year, it's very difficult to attract the local investors.
There's other issues as well going on in Turkey as well. I don't know if you've heard, but I understand there's some new regulations that have been introduced on swaps in Europe, which they don't quite meet the standards. I'm not quite sure if you've heard about that at all. Okay. So Vakif Bank did like 3 private placements recently in Turkish lira, and they were explaining to me that the reason that they did that is because they didn't comply with some new swap regulations that came into place sometime towards the end of last year.
In Turkey?
No, in Europe.
Oh, Europe.
Yeah.
But then how much of the, with the political situation in Turkey, how much do you believe it slowed down potentially the development of the investor base and
It slowed down quite a bit. I mean, but on the other hand, what we've seen is the Turkish banks, they still have access on the unsecured. They're still successful in the market. They even issue sub-debt on the international market. So it had an impact on the spread. Obviously, I mean, we've seen quite a widening.
Yeah.
It's been quite volatile, but it widened. But they're still managing to tap the international markets.
Okay.
So, I mean, you've said why, what you can invest in. Do you think Pictet or investors like yourself would ever change their investment mandate to buy emerging market bonds, or do you think it's just going to cover bonds? That is, do you think it will always remain in that sort of line where you've got this sort of investment grade mandate and that's it? The emerging markets are. I mean, is there a possibility of things ever moving, that they get a new fund developed or a new pocket of demand coming through?
I mean, I think it's hard to see on the treasury side, not only because of regulation, but as well as a Swiss private bank. We are ultra conservative. But I mean, Pictet as well has the asset management side, and this is where emerging markets could be interesting for some high-yield mandates. So on the treasury, difficult, but yeah, maybe on the asset management side.
Yeah, maybe. Okay. So, I mean, certainly some of the Central and Eastern European countries now, with rating upgrades coming through, there's a prospect that they might even get to AAA on some of their covered bonds. I mean, let's take Poland for example. They've been a trailblazer. We've had 2 issues from 2 issuers now.
Yeah.
There are a few others coming, aren't there? Potentially.
Yeah, I mean, the Polish market, I think, out of the sea is one that has the highest, potential for development. The new legislation has been in place 2016. We are in 2018. Then there are already 4.5 billion euro of covered bonds in the market. About half has been issued international through benchmark or sub-benchmark issues like mBank. Half is the local market. The limitations of the Polish market is that you have to have basically a mortgage license in order to issue covered bonds. Some of the banks apply for a license immediately. Some of them, they're still working. So at the moment, basically, there are just 3 potential issuers. However, we understand that there are 3 new applications for licenses, so this will make 6, which obviously will have an impact on the development. What I like about the Polish market is that you have a very nice local investor base. I mean, there are pension funds, insurance companies that they are investing. So all these banks, they have access to both local and internationally, which is very good because Poland is not Eurozone. So in terms of hedging, if something happens with the euro-zloty swap, they can go back to the local investor base, which is limited but is growing because we've seen like the local benchmark, it's 100 million euro equivalent in zloty. Which is it's a good size for the market, and this obviously helps because you tackle both investors. So yeah, there is potential. It's 100 billion in terms of stock of mortgages
in Poland.
Yeah. 4.3 billion of covered bonds, so 4.3% of the mortgage stock financed via covered bonds. This is on the lower land compared to developed markets. So yeah, it has a big potential out of any other Central Eastern European. Another country which is not CEE, but maybe it's worth mentioning, it's Greece. Mm-hmm. So Greece, we're all aware of all the challenges with the economy and everything. However, last year, Greek banks started to tap the covered bond markets. They had programs pre-crisis. Only one issuer was 2008, NBG. But it's been, they've been quite successfully, positively successfully. They started with a 3-year last year, and then there were 2 issues of 3 years, 1 of 5 years this year. Initially, the Greek covered bonds program, they were eligible for the CBPP3, However, in the meantime, in February, I think ECB announced that because of the conditional pass-through and because of the lower rating, they're not eligible anymore. So one of the issuers changed into a soft bullet, the January issuance, which was very successful. Greek banks, they need liquidity, and covered bonds is obviously an instrument that assures this. They have to refinance all this ELA funding, which is quite significant. So despite the low rating, they are a single B because of the country ceiling for Greece. They've been very well received by investors looking for yield. So I understand that the investor base, they are pretty much emerging market investor base, not the traditional covered bond. However, I mean, all these issues, they've been oversubscribed from 2.7 to 5 times the most recent one. So I think in terms of like new markets for covered bond, Greece eventually Greek banks will continue to issue. There might be some, I don't know, in terms of country ceiling, if things will change, these programs, they had potential to have an uplift on the rating. They originally, 2008, I think they were AAAs when they were first structured. So I think Greece might come up as a new emerging market, although it's not really emerging market.
Yeah, no, well, it kind of, like you said, it was bought by some emerging market investors, I think. I know if we're going back to Central and Eastern Europe, kind of after Poland, the next one after that is the Slovak Republic, and they've recently updated the law out there, haven't they? So how's that going? Is that work sort of done, or do you think that's going to... There may be more work that needs to be done there.
Well, Slovakia had legislation, a covered bond legislation, quite outdated. I think it was 1997. So there have been lots of structural issues that had to be amended. So we've been involved there with the Ministry of Finance of Slovakia. We worked with Richard Kemish, that I think many of you know, on the amending of the new legislation. And we are very positive, and actually it was quite a record time, because I think we started looking at it in February, March. By the time we signed the contribution agreement was April. Anyway, basically 6 months later we have a new law in January this year into force. So it's been quite a quick turnaround. We've been supported by the Banking Association, Ministry of Finance, Central Bank. So everybody was in agreement that something has to be done. So now there is a new law that has been amended. There are, most of the weaknesses have been reflected in the new legislation. Just to mention very briefly, so we had the refinancing ratio of 90% in Slovakia, according to which basically you have to finance 90% of the mortgage loans via covered bonds, but this would limit basically the maximum OC you can have to 11%. So this basically, you have a limitation on how much OC you can have in the program. Now it's been completely removed. This also had implications on the structure of the Slovak market, on the Slovak covered bond market, because banks were forced to issue regularly, but small issues. So we've seen issues from 25 million euro to maximum 50, because every month they have to issue according to how many mortgage loans they generated. So this has been completely removed, which is very, very positive. Now we have a minimum level of OC in the legislation of 5%. There has been, in the definition of the cover pool, now the housing loans have been added. In the past, there were mortgage loans, and this gives a wider scope for basically the availability of the mortgage loans in the market. They're about 24 billion combined. There's been introduction of the liquidity test, so it's up to 180 days. In the past, this was not existent. There is the cover monitor and the replacement cover monitor. So quite a few positive changes. One of the issue that still remains is this acceleration of the put of the cover pool upon issuer default, which has not been changed. However, a new feature has been introduced, the soft with 24 months extension, which mitigates the risk. So lots of positive features. They're still working on the secondary legislation, and we hope to have them soon. So looking at the stock of, I think they have at the moment 4 billion of covered bonds outstanding out of 24 billion mortgages. However, I believe that the new legislation will encourage banks to issue more size. So we have already 2 sub-benchmark last year issued, And I know that banks now can issue, they are looking to go either for sub-benchmark or benchmark issuance. And also we'll have to see in terms of how the new legislation...
Euro benchmark
Yes,
size?
Euro benchmarks,
Okay.
yes, yes. So, and also need to see how this is going to be impact on the rating, because at the moment they're AA, the programs. However, with these positive features, we might expect a
Triple A.
slight uplift, yes.
But the country's not AA, is it? Slovak Republic is not.
It's single A.
Single A, yeah.
Yes.
So you still couldn't invest in that.
But the programs are AA plus.
Yeah,
Double A
yeah,
plus,
but they could be AAA after the
Yes,
fairly soon.
we hope so.
Yeah, well, I know one of the big issuers out there hopes so. When we're thinking about Romania, I mean, it's a tiny market, but they've updated their law as well, and things are progressing there. But there was a bit of an own goal recently, wasn't there? There was 2 different laws came out at the same time, and they kind of conflicted. What can you tell us? What happened there?
Yeah, sure. Romania, yes, we've been working in Romania on the cover bond law for 10 years. Finally, it was changed and adopted in 2016, but we haven't seen any issues. There have been lots of regulatory changes. There was the introduction of this walk-away law, according to which you can just give the key to the bank if you don't want to pay with no reason, especially. So, and this, of course, had an impact on the market. Banks started to increase the minimum LTV to 40%. This completely stopped any mortgage lending. In the meantime, there have been some court decisions that actually you can't just give the key, you have to have a reason. So there have been some court situations. So now I think this has been a bit stabilized. The banks, they went back to 25% LTV, so the market it's started to grow a bit. But I think the issue in Romania is that there's lots of liquidity in the market. Banks, they hardly do any lending. They have the loan-to-deposit ratio, it's very low. So they have lots of cheap funding. There is no real incentive to go to the market. Even on the unsecured, I think there are 4 issues out of the full market, so it's very, very limited. So there is no, and also from the regulator, we don't see it as a strong push or support of this type of instruments. So okay, there is the legislation, but we don't see this drive of the regulator to push the banks to try to diversify their source of funding. I think what they basically need a kind of pioneer. If one of the banks, has the courage to do it, I'm sure that the others follow. This happened with the unsecured. After the first bank issued, then we've seen immediately 2 others following. Right. The stock of mortgages is not very big, so it's 10 billion euro equivalent. So I would expect mostly like local issuance initially, potentially a sub-benchmark in euro for some of the banks that they have the mortgage portfolio in euros, but now most of the lending, it's in local currency, so it's in lei. So they have to hedge it as well. That will add a bit of a cost.
So in terms of what's been going on in the Baltic region lately, we've had some quite interesting developments there, haven't we? That sort of the 3 regions have been working together on producing a framework.
Yes.
We can expect maybe something to pop out there at some point.
Yes, we are involved, and actually, it's my colleague here, Jacek. I think the one that attended yesterday. It was we had a panel on the new markets, and this was mentioned. So we are working with the 3 countries to develop a cover bond legislation in each country. A cover bond legislation that it's very uniform and standardized across the 3 countries, with the idea to create a kind of cross-border type of structure, because the banking sectors in these countries are pretty similar. They're pretty much the same Nordic banks. They have subsidiaries. Mortgage markets are very similar. They are small, so the total of the 3 markets, the total mortgage loans in the 3 markets are, I understand, 16 billion euros. So they are small in their own, but combined, it's quite a good size. So yes, we are working on this. I mean, Richard is working with us on this. So we are confident that once this legislation is going to be in place, we can see some issuance. It's going to be a pioneer in this respect. There's been some cross-border transactions in the past, but very, very limited, as I understand.
So will that be local currency or euros?
Euro.
Yeah.
Euro. They're all euro. They're all euro.
I'm not up to date on who's joined the euro recently. Sorry, excuse me. So, question for the audience now. Will the covered bond directive help spur growth in new and emerging markets? So everyone's been hailing the covered bond directive as a good model for newbie issuers, newbie countries to come on board and follow some guidelines, basically. So what's our answer? Okay. Yes, very good. Okay, so why do you believe the directive might be a good thing, Anne?
Well, for several reasons. I mean, it's a good thing. First, it shows the importance of the product. You know, it's a key funding tool in Europe, or maybe it's because the ECB has a lot of covered bond on balance sheet and needs to be sure that they don't blow up. But definitely, it's a positive signal. The other thing is that we might have, I mean, new markets when they come up. You know, they don't have to think about shall I copy the weaker French or the stronger from briefer market. At least you have a toolbox, as Luca was saying yesterday, with the key features to have a successful covered bond market. So I think that's important as well for the new market to come up. And then looking at, I mean, it brings as well some clarification on a number of key points. And one of the key positives I can see is this specific public supervision. I mean, at the time, if I remember well, Northern Rock, I think they guaranteed a number of liabilities and they forgot initially about the covered bond because it was not so much important. And this kind of mishappening won't happen again. And the other thing which is key for investors is that you do have some flexibility. We are strict in our investment criteria, as you can see. Having said that, we are happy to buy a farm briefer with commercial real estate, as I was saying yesterday. So I think it's very important that we can still see these kind of assets. So I think it's well done, and the fact that they took the best practices is, and they took the time.
So, from your perspective, obviously very different markets, but does it help, do you think, the EBRD sort of exert some sort of leverage on countries to say, look, here's the directive, it's only a proposal at this stage, but at some point it's going to be law. This gives you a very clear idea of what is the gold standard, whereas at the moment, you know, potentially they could just argue, well, we don't have to do that because they're not doing it, or because there's no clear. How do you view the directive? Does it help you when you go out and visit some countries which are considering, you know, laws which are maybe not, which you don't think are up to quality standards?
No, absolutely. It's definitely will be very helpful. In the past, we used EBA guidelines as when we're talking with the authorities, we're trying to benchmark the existing legislation. But in some cases, we've seen some reluctance or resistance, or basically just don't see the need, because if you have a local market where very small issuances and you have a local investor base that they basically accept that type of issuance, because it's a name lending. So it doesn't matter if it's a covered bond, it's an unsecured, they are familiar with the name, it's a big bank in the country, it cannot fail. So, I mean, from this point of view, there's no incentive to do anything. But now having the directors, and we actually have quite concrete situations where we had this kind of conversation with authorities. It was very difficult to try to move the needle towards more market standards. But now with the directive, I think will definitely help. It's a European directive, so it's principle based, and will have more leverage, I think, now in the discussion with the authorities, because it's something they have to do. It's something they have to prepare to do, because if there is no covered bond legislation, or if it's very outdated legislation, they'll have to start thinking about it, because it's not only changing one law, you have to go also in the bankruptcy law, so there is quite a lot of work that needs to be done in some of the cases, and having the directive definitely will help us.
And in the area where the directive is softer than the EBA initial recommendation, are you still going to show the EBA?
We like the EBA, so yes, we use the principles, so yes.
And do you see any negatives coming from the directives? I mean, there's, at the moment it's only a proposal, and some of the things could be cleared up. So when we get the final version, no doubt they will be cleared up. But at this stage, having seen the draft and the whole concept of harmonisation, do you see any negatives coming out of it potentially?
I mean, the key negative is they really need to close this SME loan option.
Loophole. What,
as
assets?
Eligible, yeah, other assets.
Yeah.
I think it's really critical. And the work on the ESN, which is being done separately, that's a good idea. Because the thing is, if we have SME loans and one day you have a mishap, I can assure you that at PICTE, we will forget about the name covered bond. I mean, I won't be able to say, oh yeah, but it was a special case, etc., etc. It will be the reputation of the product which will be killed. The other thing is, as I was saying yesterday as well, I mean, the EC label, I'm really confused, and I see no point in that one. And actually, it looks to me like a certification, and it's super dangerous. As an investor, we really need to do our own due diligence. And even though you have a directive with strong core features, you will still have a different risk. It's a different macroeconomic environment, different banks, different housing market, etc., etc. So,
but if everyone's reporting on a sort of harmonised transparency template, which is what the label is aiming to do,
yeah.
Does that not make work slightly easier for investors to compare like for like?
I think a label like the ECBC label should help you to get the data, compare, identify the eligibility or not from a regulatory point of view, but it shouldn't be saying that it's a quality product, for example. And then I think there are still small details to be fixed, like defining the trigger for the maturity extension. I think 5% OC is too low. Liquidity buffer is great, but what if we have only 2B assets? So this kind of, and as well the LTV. I think there are soft LTV. So, yeah. And I think they should have started with hard LTVs, because it's a good indication of the quality of a mortgage, and it's not happening. So.
Yeah, I mean, I think there are all reasons why those things didn't happen, but yeah. Anyway. The other thing is regulatory equivalence. Do you think that's a good thing? I mean, presumably you do. It will allow you to...
Yeah, I mean, it's super important for us.
Yeah.
And it's got to be coming from the EU towards the non-EU, and vice versa, obviously. It should be bilateral. So
we're kind of coming to the end of this panel session, and I just wanted to open it up to the audience. Does anybody have any questions regarding any of the subjects that we've been talking about? Optimal allocations, yes.
Yes, it was weird. I have a question to answer. When we were talking about emerging markets, you mentioned Baltics, and you were, let's say, interested to hear the developments, and that would be a potential investment if the bonds come to the market. Yeah. But how about other countries? Because you didn't mention, for example, Slovakia, which is also the euro-denominated jurisdiction that already gonna come to the market. So what it is that you're looking at when we are working on the emerging markets that is more attractive or less attractive for you to decide to invest?
Good question. I mean, the Baltics, because of what was mentioned, the fact that you have a high influence, from the Nordic, and the Nordic we consider as a stable, and as well, I mean, politically we need to have a stable environment, and as well, I know the Baltic market, having been a bank analyst on that market at Moody's some years ago. So definitely, I know the quality of the banking sector, etc., etc. So I mean, aside the rating limits we have, as well, it's good to be comfortable with all the other features. And I think for me, the Baltics is I wouldn't say a subsidiary of the Nordics, but it's.
Do we have any other questions? No more questions. So that brings us to the end of the last panel of today. Thank you very much.